Okay. Uh, Nina, we live? Yep. Okay. Uh, we are live, so I'll get started because a lot of people are waiting. Um, just give me 1 second. Nikhil, your recording has stopped. Uh, Nikhil, can you just refresh your page and quickly come back? Okay. Okay. Hello, everyone. Welcome to this webinar where we discuss what are alternative investments and why you should consider investing them as part of a diversified portfolio. Today, we have Nikhil and Apurva with us for this discussion. Let me quickly introduce these two for you. Nikhil Agrawal is the founder and group CEO for Grip Invest, an alternative investment platform offering high yield investments starting at just 1,000 rupees. Prior to GRIP, Nikhil was a consultant with the World Bank for their transport practice. Nikhil was also one of the co-founders of Chalo, India's number one bus transport tech company, and a vice president in Morgan Stanley's investment banking team. Nikhil, welcome to the podcast.
Thanks, Yash.
Uh, Moving on to our another guest, Apurva. Apurva Sharma is the managing partner at Stride Ventures. She holds the distinction of being one of the first Indian women to hold the position of a managing partner at a venture debt fund. Apurva has over 11 years of experience in the lending ecosystem. She oversees critical functions like fundraising, investor relations, and lending ecosystem and deal sourcing. My apologies. Apurva's professional journey began at HSBC, where she contributed to the debt capital markets and successful bond issuances. Later, at Xander Finance, she played a key role in deal sourcing and structuring investments across various sectors. She is also a CFA charter holder and has done her postgraduate diploma in management from IIM Shillong. Apurva, very warm welcome to this podcast as well.
Thank you so much,
Now,
Yash.
we'll also have Ishpreet joining, who's the founder and managing partner at Stride Ventures, in another 15 to 20 minutes. So stay tuned. Uh, what I'll quickly do right now is set the agenda for our audience tuning in for the first time, very quickly. So, just to set out some context, along with these two guests right now, we'll be discussing key questions like what are alternative investments? Why should they form part of a diversified portfolio? What alternative investment options are available to retail investors as well? And many more. So, do stay tuned. This is the second webinar in our AltXtra series, which is curated by Alt Investor, which runs the first and largest community on alternative investments. The Alt Extra series is proudly powered by Grip Invest. I'm Yash Roongta, and I'll be your host for this series. While I do discuss some key questions I have on this topic with these two guests, I would request the audience to keep their questions incoming. There will be a chat box wherever you are watching this live. We will pick up as many questions at the end of our discussion and get them answered for you. Great. Are you both ready to get started? All settled and comfortable? Yeah?
Absolutely. Yeah.
Yes.
Okay, great. Great. Apurva, I'll come to you first. I believe Stride Ventures had the first, was one of the first and largest AIF funds into the industry. Can you give us some idea as to how the AIF industry has shaped up in the last 10 years? Was it always rosy, or the growth has been steady, or there has been some form of exponential growth right now?
Sure. So, Yash, within debt AIFs, so AIF, of course, there are equity AIFs as well as
Sure.
debt AIFs. And within equity AIFs, there could be venture capital allocation or a private equity allocation or, say, a seed fund incubator kind of allocation. I'll speak mostly about the debt AIF segment,
Sure.
which can be very vast. Within private credit as such, there could be, structured finance, which is essentially for either acquisition or promoter buyouts or very long tenor structures, back-ended principal, ballooned principal repayment. There could be infrastructure related AIFs, for toll roads, bridges, those kind
Hmm.
of infrastructure assets. Then there could be real estate AIFs which only invest in real estate, residential or commercial. And then there's of course venture debt. So within venture debt, essentially, this asset class globally has existed for over 2 decades, but in India, it has really grown in the last 6, 7 years. The asset class was very small, about close to say $250 million in 2016-17, when
Wow.
the asset class
Hmm.
first came into picture in India. And just about 1 or 2% of the venture capital deployment annually. It was very, very small. And the reason was that
Hmm.
for people, it was difficult to understand the asset class. We were lending to companies that were loss making. And, every time we went to the investor, their questions would stop at, if there is no EBITDA, no positive EBITDA, how are they
Hmm.
ever going to service interest? So, of course, there has been a lot of maturity in the ecosystem, both on supply side as well as demand side. From 2016 to now, just last calendar year, the full year annual deployment was around $1.2 billion. So it has come a very long way in terms of the quantum of deployment. And in this journey, the asset class has evolved on both sides. On the demand side, companies have understood, founders have understood that equity is costlier than debt, and you need to use some part of debt in your capital structure, especially for use cases like working capital, capex, acquisition financing. Essentially, wherever there is an asset getting created on your balance sheet, you should finance it with debt. And for use
Got
cases
it.
like, you know customer acquisition or new product expansion, R&D, those kind of things, of course use equity. So keep a healthy
Hmm.
balance of equity and debt so that you're not diluting yourself pretty early in your journey. A lot of it has also
Hmm.
come through, obviously, word of mouth, the fact that people, other fellow founders have taken venture debt, benefited from it,
Hmm.
and so the ecosystem has evolved. On the LP side also, given that this asset class has had now a 10-year kind of history. Domestic LPs have seen
Hmm.
cycles of funds getting returned, multiple quarters of distribution, say 30, 40 quarters of distribution that have happened over the last many years. So that has given them comfort that it is a sweet risk return profile asset class where you have a recurring, predictable, fixed income like cash flow, along with, say, an equity kicker at the end, which can benefit or bump up your IRR. So it has been a good
Hmm.
learning curve. But yeah, that has been the evolution of at least venture debt as an asset class in the last 10 years.
Got it. And Apurva, I'll just probably take a step back here. Could you explain what is venture debt to the larger audience that is viewing this webinar today?
Sure. So, venture debt is essentially lending to growth stage
Hmm.
companies that are backed by venture capital or private equity investors. It is available to any company which, say, has a defined set of revenue. So, revenue has become
Yeah.
slightly predictable. We don't invest in pre revenue companies. It could be anywhere between, say, Series A to pre IPO. So, that way, it's sector agnostic, stage agnostic after the company has started generating revenue. And typically, we enter with, say, check sizes average of $4 million, but we can go as high as
Wow.
$15 million in a single company. It has two components of return, for any investor. One is your debt IRR, which is your fixed income, recurring, predictable cash flow, which we have to pay to the investor at the end of every calendar quarter. And that
Hmm.
annualizes to around 13 to 14% net of fees and expenses. And then, as
Hmm.
part of our commercial understanding, we take about 10% warrants, which are like equity call options in the company. So
Got it.
the equity call option essentially has no downside. It has unlimited upside. So we hold it for a period
Hmm.
of 6, 7 years. It outlives the debt tenor. If during the tenor the valuation of the company increases, then we
Hmm.
benefit from that valuation bump up and pass on that capital gain to my investors. So on an average,
Got
what
it.
we have seen from fund one and two, additional 4 to 5% is what you can expect at a fund level to come through because of these equity call options, which are essentially called warrants. And that's why the overall return expectation from a venture debt fund for investors, net of expenses, net of fees, is roughly 17 to 18% ballpark.
Got it. Okay.
Yeah, maybe
No,
just
that's
a personal anecdote. In 2018, I took my first venture debt. I was in,
oh wow.
I was at Chalo, and venture debt had just happened in India, and I had never come across the concept of venture debt. In fact, as
Hmm.
founders, we used to bang our head on the ability to raise loans, to take bank loans. It was impossible to go to a bank or to an NBFC and take loans. And here comes venture debt, which in a way bridged that challenge, where you didn't have to get diluted, you didn't have to raise equity for dilution. It was available at 16 to 17%, and
Hmm.
you take money to complement the equity that you had. But I remember reading the first loan document, the venture debt loan document, and feeling that we're the birth of a very different financing industry. Obviously, folks like Stride have played such an incredible role in shaping that. I believe Apurva, probably capital under management is now 8,000 crores, so about
Yeah.
$1 billion just at Stride. But this has all happened in the last 8 or 9 years, and a different pool of investors enabled the sector. Different folks of different fund managers enabled it, and actually played a very big role in shaping startup ecosystem in India.
Hmm. Very interesting. I want to ask the equity warrants, the options, is that mandatorily exercised at the end of the venture debt tenure, or how does that work?
So if there is a markup in the valuation, suppose I'll just give an example.
Only then. Yeah.
Suppose I've given a 10 crore loan to a company which is today valued at say 200 crores hypothetically, and this is for a period
Sure.
of say 24 months. So my
Hmm.
debt retires and I've generated whatever 16% IRR, and post fees etc. I'm distributing 13-14% to my investors. As part of
Hmm.
my consideration, 10% of my debt sanction equivalent of call options is what I get in this company. So by virtue of me
Hmm.
lending 10 crore, I get a 1 crore worth of equity call option in this company, which is today valued at 200 crores. This
Okay.
option tenor generally stays for the life of the fund, which is like 6-7 years. During these
Okay.
6 years, suppose the valuation of the company has tripled from 200 crores to 600 crores, then my 1 crore
Hmm.
worth is now 3 crores, right? At that
Got
point
it.
in time, I will choose to pay you the 1 crore, get the 3 crore, book 2 crore of gains that I pass on to my investors. That is how it
Hmm.
operates. Suppose by the end of 6 years, the valuation of the company has not increased, then it
Hmm.
lapses. There is no reason for me to
Hmm.
exercise this option, right? But if the valuation of the
Yeah.
company has increased, then definitely the endeavor will be to exercise these options and book the gains.
Got it. Okay. So, okay, I understand that very clearly now. I'm assuming a lot of your investors in the venture debt category are family offices or other ultra high net worth individuals. I want to ask what particularly excites them to invest in this space. Is it just the higher returns within the venture debt category, the possibility of higher returns, or diversification, or even something else?
So it's a mix of everything. Yes, generally, whoever when we speak to bigger family offices, everyone has an IPS defined, right? Which is, uh,
Mm,
say, maximum amount will be towards public equity. 60-70% of their portfolio is public equity. The rest they will diversify within, say, fixed income bonds, or they'll have some allocation for alternative assets, maybe some real estate, something like
mm,
that. Everyone has a different IPS depending on their risk analysis, where the stage of their life, their succession planning ambitions, etc. Right? Also the color of the
mm,
money. Is it a treasury money? Is it family earned money? How uh, conservative do they feel towards that capital, etc. But
mm,
when it comes to alternative assets, I think everyone in their portfolio, at least 10 to 15% is definitely alternative assets, is a broad average that I have seen in my conversations with family offices. And within
mm,
that, then they look at their liquidity requirements, right? So AIF obviously has lack of uh, that liquidity, right? It is not very liquid. It has slightly longer lock-ins, say
correct.
4 years. And So within that, if you look at VC or private equity, it could be a 10-year kind of lock-in, but there the return expectation could be 30 to 35%, say. Here, in this
Hmm.
case, it's a much shorter holding period, 4 years. And even within that 4 years, it's not that your capital will come only at the end. You are getting recurring cash flow, pretty much like, regular for all your expenses or whatever you have, the liquidity needs that you have in the short
Hmm.
term. So here the expectation would be the, say, 17 to 20% range. So depending on that 10-15% bucket that they have for alternatives, then they divide it depending on the liquidity expectation, whether it's equity, whether it's debt, so on and so forth. So I'd say diversification is a prime reason. Of course, this has higher return expectations. So
Hmm.
diversification and higher interest expectations. A third reason I'll also say is co-investment. A lot of times when
Hmm.
family offices want to enter this full startup domain, right, they are also looking
Hmm.
at getting access to high quality deals. So in
Hmm.
many cases, we give co-investment rights to our LPs. So if there is a company that is doing really well and you want to invest in it, and Stride is an investor because of the co-investment right that Stride has, we can pass on that right to our LPs, and you can generally stay updated about the ecosystem because we are sector agnostic as well as stage agnostic. So it gives you a good, I'd say, fundamental understanding about the ecosystem before you enter, say, specific companies.
Sure. Okay. Thank you, Apurva. I just want to clarify for the audience that's watching. LPs are limited partners. Uh, in an AIF fund, there are two different types of partners. One is a general partner, one is a limited partner. General partner is the one who is evaluating the deals and then finally making the investments. Limited partners are essentially the investors within that fund itself, and they invest alongside the general partner multiple times. Uh, so yeah, just clearing up the terminology a bit. So Apurva, just a follow-up question onto that. If let's say of course, diversification is a key reason. It's one of the biggest reasons for alternatives as an asset class. But if let's say the reason is high returns, if particular family office is investing because they think 16-17% is a very good high return. Uh, Given the stock market, equity stock market has been performing exceptionally well with people realizing 40-50% gains in small cap stocks. Do you think these family offices or other institutional players will reallocate some of that money from the alternatives bucket or specifically debt based alternatives bucket into more broader equity based investments into the stock market?
So it depends, Yash. I've seen that the bigger family offices are extremely disciplined in following their IPS, and no matter, even
Hmm.
if you're saying short term, I'd say hyper return in a particular asset class, you don't deviate from your overall allocation because in a 10-year time frame,
Nothing
the
matters.
public markets are, yeah, and the public markets are not going to give you that 30-40% return over a 10-year
Sure.
horizon, right? So for bigger family offices who are very structured in their approach, I've seen them to be disciplined and they continue with their thesis.
Hmm.
Of course, family offices which are new, or they're just institutionalizing it very early in their journey, they do tend to get attracted by
Hmm.
whatever is currently in vogue, and they will allocate a lot of their capital to assets which are giving those hyper returns for short term.
Got it. Okay. Okay, thank you, Apurva. Nikhil, will come to you now. You know, uh, Probably from a retail investor point of view, can you try and explain what is the difference between a traditional investment option and an alternative investment option? And let's try and do that with the context as to what is the difference in the West, US, Europe, and what is the difference in India?
Sure. So the if you look up the definition of alternative investments on Google, it will say, it's a funny definition. It says whatever is not traditional is alternative, because it is so there is no clarity, and the definition of alternative can include different things depending on how you see it. Like you said, it may be different by geography. It may differ by market. It may also differ by what you are aware about and what you're not aware about. Now, for many people, corporate bonds is alternative in India, but actually corporate bonds is one of the oldest, most traditional sector, right? So I think it really depends. But let me try to answer your question more directly. Um, in general, savings deposits in banks, stocks, and real estate. I would say stocks, not even real estate to a large extent, are considered, and gold are considered to be traditional. These are assets that most people have have in their portfolios. They have seen their parents have it in their portfolios. They've seen the grandparents have it in their portfolios, and it is a very common topic of discussion in the house on how to build savings and investments. That is actually how I define traditional, right? Which is coming from really a family background to say this is what you must invest in when you start earning. Matlab, first salary say ye karna. That is traditional. Okay. I think everything else becomes alternative, right? So anything that goes beyond this, people normally see to be either I don't understand well enough, or is high risk, or I don't have access, right? I think
Hmm.
alternative assets are typically things that meet one of these three buckets. If I look at the
Hmm.
AIF industry in India, where Apurva has been talking about, AIF industry in India is relatively new. People have had limited understanding of it. There is a
Hmm.
high risk, especially when it comes to equity based AIFs, and the minimum investment amount is 1 crore rupees, so the accessibility is
Hmm.
more limited, and hence this has been
Hmm.
classified as more alternative investing. If you look at the US markets, however, or the West markets, some of these same asset classes have been in the awareness and education of people for a much longer period of time. These are more sophisticated, more mature markets. And there, the definition of alternatives may, for example, include investing in whiskey or wines
Hmm.
or art, which is much more exotic using the same definition, right? So I think that at a high level is what alternatives are. Maybe
Hmm.
the last point I'll add is from a Indian retail investors lens, right?
Hmm.
We have unfortunately been curtailed to invest only in either the stock market or in bank deposits. Even real estate, apart from owning a home, was a difficult consideration for 99% of Indians. And hence, all
Hmm.
other asset classes really became alternative.
Hmm. Got it. Okay. Apurva, do you think debt, and Nikhil touched on this a bit earlier, do you think debt is considered as an alternative investment in the Indian context?
So yes, I think when it comes to I'd say in public markets, it maybe not. So even in
Hmm.
mutual funds, people are very comfortable in spending in, say, dividing between equity mutual funds and debt mutual funds. So public debt
Hmm.
is not alternative. I think it's people are very aware of debt mutual funds, hybrids, which invest in equity as well as debt. But when it comes to private market debt, definitely it comes under alternative, because as Nikhil said, people don't have access to it, and those kind of instruments. Also, the information with respect to private companies are difficult to access, so underwriting them is also difficult on an individual case by case basis.
Hmm.
Public companies are very well covered. There are so many equity research analysts, buy side, sell side, they'll give all their reports, so there's a lot more
Hmm.
talk. So of course, I'd say access to information and access to instrument is both restricted, because of which they feel that probably this is not a very well understood
Hmm.
department, and that's why alternative.
If I can just add to
Got it.
this, Yash, you
Mhm.
know, again, because of lack of access and understanding, debt has all forms of debt have been largely outside Indian portfolios. Okay, I think it was maybe on the last webinar where we had Ashray, but he said a very interesting thing. He said people think about savings and they think about investments, and they think of them in two separate buckets, right? So when you think about fixed deposits in banks, which is nothing but a debt based investment, you think about it in the savings bucket, right? And we have been
Hmm.
programmed as Indians through our family system to think about giving out loans or fixed deposits only as a savings instrument and not as an investment instrument. So the kind of high yield debt or high yield bonds, NCDs, AIFs that we have access to now are definitely considered alternative, and awareness about them is quite limited.
Got it. Okay. Thank you, Nikhil. Apart from debt-based alternatives, Nikhil, what other options are available to retail investors in this same category? Maybe on the equity side, property side, or even crypto?
Yeah, things have really changed in the last few years in terms of access of these alternatives for retail investors. 4 years ago, when we started Grip Invest, most of these options were not really available in a regulated manner, but that has now dramatically changed. If I can just maybe pick on one by one, equity
Yeah.
investing, even in unlisted equity or startup investments, has now become regulated through SEBI Cat 1 AIFs, where you can commit to invest 25 lakh rupees and invest in early stage companies. I know that platforms like Let's Venture, Anikut's platform, Angel List, which do offer these investments, and you could be an investor in a Blue Smart. If you were lucky, you could have been an investor in Zepto. If you were unlucky, unfortunately, Byju's. But these were platforms where these investments were possible, and many Indian investors did access them. On the debt side, I think the biggest change actually has been the introduction of the OBPP regulations, and where investors can now access corporate bonds giving between 12 to 14% um, at 10,000 rupee face value. And this is available all with the security of transactions happening on the stock exchange, instruments being held in a demat account, and giving very attractive inflation beating returns. And then maybe finally on real estate, SEBI came out with regulations called the small and medium REIT regulations. It's called the SM REIT regulations, which now allow commercial real estate to be fractionalized and offered at 10 lakh rupee ticket size, making it once again accessible. um, I missed crypto on purpose. I think crypto is still is available. It's however unregulated. Taxation is clearly punitive, and if you've been following Wazir X, I think there are a lot more risks to that situation. And I think there are other regulated assets which can give you the flavor of alternatives today.
Sure. Okay. You already talked about the regulation, Nikhil, but I just want to talk about the role of the regulator as well, SEBI. What is SEBI doing more in terms of making these alternative investments more accessible? Reducing ticket size is one by the means of fractionalization. But do you see any other avenues that they are playing around with to make this more accessible?
Yeah, I think SEBI has played a beautiful balancing act. Okay, I'll just take a pause. Hi, Ishpreet.
Hi, Nikhil. Hi,
Hi.
Yash.
Hi,
Um,
Ishpreet.
Maybe I'll complete the question, Yash, and then you can go back to introducing Ishpreet. But
Sure.
I think SEBI has played a beautiful balancing act between enabling alternative investments for retail investors at small ticket size, while at the same time protecting their interest. Right? So expanding the market, but putting the right safeguards in place. I'll give a few examples. So for corporate bonds, you can now offer them at 10,000 rupees, but there has to be a SEBI regulated merchant banker who evaluates and does diligence for each corporate bond. Each corporate bond must then be rated by an independent rating agency like CRISIL, and it has to be executed through the stock exchange, providing for higher diligence, disclosure, as well as security of transaction. Similar safeguards have been put in place for the SM REIT regulation, and hence SEBI has done that action. What it has also done is, and in my previous example, enabled all of the stakeholders, the entire infrastructure, right, the entire stock exchange infrastructure, to support retail investors to do such investments and diversify their portfolio.
Got it. Okay. Thank you, Nikhil. So looks like SEBI wants retail investors to participate in the alternatives category, especially into the debt category, I'm assuming. So it's a good step, I would say. Uh, uh, Coming back to Ishpreet. Hi, Ishpreet. Good to have you here finally. I think a lot of audience members were waiting to see you around. Uh, what I'll do is quickly introduce Ishpreet to everyone. So, Ishpreet Singh Gandhi is the founder and managing partner at Stride Ventures, India's leading venture debt. As you might already know by now, they have dispersed 8,000 crores worth of venture debt and other category of investments via Stride Ventures. Uh, Prior to founding Stride, Ishpreet has worked with several banks in several senior positions. Like with IDFC Bank, he was the head for North and Eastern regions for MNC and startups. With Yes Bank, he was the senior VP for the MNC and startup banking segment. And prior to that, he was with Kotak as chief manager for corporate banking. So Ishpreet has a lot of domain expertise in enabling financing for the small medium enterprises or MNCs or even startups. Stride Ventures, as we all know, has done more than 8,000 crores in terms of venture debt funding via the AI, a significant number by all means. Apart from venture debt funding, Stride has also invested in companies like Grip Invest that is in the alternative investment space. So welcome, Ishpreet. Finally, good to have you here.
Thank you, Yash. Thanks, Nikhil. Thanks for doing this. Always encourage initiatives around propelling alternate investments. And nobody better than Apurva representing us and leading this charge. Just to get it right, Purva has been with me since day one, and all the 8,000 crores which you mentioned, she has done, and she represents the fund now in terms of the raise and deployments. So I've been just around her now for a while. So let her take the lead, and I'll keep on supporting. So glad to be here, both of us.
Yeah. No, that's great. Good to hear, Ishpreet. I'll come to you, Ishpreet. You have actually come in at the very right time for the right question. I want to talk about, Stride has done an equity investment in Grip amongst all other investment platforms which are available for retail investors in the debt alternative space. Uh, First question is why Grip Invest? And second question is why do you think retailers should invest in these kind of alternative options?
A great question, actually. I would rather want to comment on this question because I have a unique answer. When Nikhil met me for the first time and he told me that he's doing the round for Grip, I said, Nikhil, I've attended one or two of your webinars. And he was surprised. Are you sure that you're following this? I said, yes, and I think you're doing a great job because India needs to know that there are instruments like these available. And the most important thing, Grip Invest is trying to do it in the best manner, which is more regulated. Right? Regulation is important. Everything done in order to protect the fiduciary responsibility of capital of an investor is very, very critical. At the same time, they should be exposed to alternate ways of investing beyond the deposits and bonds. So I know now you have bonds on your platform and it's much more diversified. But the whole thought of educating, be a great team coming together to do it, see, and more importantly, is the element of regulation being at the forefront of Grip Invest journey. I think all of these coming together makes it a very, very unique platform. And I still believe we're just getting started because this is still new to India. There are a lot of things which people would not want to know. And we at Stride have been doing it ourselves, right? Apurva and me have been going around in order to tell that this is the alternate investment funds with quarterly coupons in venture debt is equally construed as a fixed income instrument. People have to get perspective of various asset classes, right? Alternate investments need to pick up in India, and all of us doing the same job. So it became an easy decision in order to make sure that all of us are convinced together to look at an equity investment and propel it together. Right, Apurva, do you want to add on something?
No, Ishpreet, you've covered all points, but yeah, I think Grip is definitely one of the only players to be fully regulated, and they have made sure that they are fully aligned with whatever SEBI needs alternative platforms to do, which is not very common. So, fully regulated and democratizing the access to alternative assets, given that now the corporate bond size has reduced to 10,000. There's a lot that can be done in the market, and I think Grip has the highest market share when it comes to retail SDIs.
While I obviously appreciate the sentiment and the positive responses, I think I just like to add something from my perspective. Having seen alternative investment AIFs really come into India, I think a lot of what we wanted to do with Grip 4 years back was make sure that that same access is available to retail investors. And we are not alone in that journey. I think there were a lot of other companies who wanted to solve for that. Because if there are these attractive returns, and Ishpreet and Apurva have proven that there are attractive returns in the AIF space, they should not only be restricted to family offices, corporate treasuries, and the top 0.1% of India. I think the idea was to, for this entire industry, and what SEBI is doing now is to bring that in a more democratized manner. And I think that was thesis with which I remember Ishpreet and I spoke about before the investment was done.
Fantastic. Win-win for everyone, I guess. We've talked about, retail investors should invest in alternatives. I want to make it a bit more personal and probably put you guys on the spot, starting with Ishpreet. Do you own any alternative investments in your personal portfolio as well?
First of all, yes, I don't have any option but to do that. So all my main capital, all my large portion of capital is locked in as sponsor capital for Stride Ventures, which is an alternate investment fund. But besides this, also, I totally believe in ensuring that it's a very diversified pool. Rather, I have zero fixed deposit if it helps the case. Right? I have maybe my risk profile is ideal risk profile for Grip Invest in terms of ensuring that I have a very diversified, high yielding asset with adequate understanding of what kind of risks we are entering into. So fairly, I've invested in alternate investment fund and debt and equity also. Besides, right? So basically, I have a significant exposure. So that answers the question.
And any sort of crypto exposure as well, Ishpreet? Crypto or art or other exotic alternatives?
Yeah, I've not reached art till now. I'm still understanding. I think near,
Okay.
but crypto, I've not understood myself till now, unfortunately. And as tried, also we have a very limited understanding. We believe. I'm not of the opinion good or bad, but at least personal capacity, I've not done that. Apurva will surprise me in case she has an exposure to crypto at
No,
least.
I have no understanding of crypto. Stride has no exposure in crypto, and none myself. Yeah.
Any other alternatives, Apurva, on your side? Of course, apart from whatever you have done in Stride via Stride.
So in the last 2 years, yes. Before that, I also was pretty new to the alternative asset class, and like every professional's journey, it starts with SIPs, and then once you have more understanding, and of course, because now that I've spent so much time in this industry, the understanding, as Ishpreet said, of the alternative asset classes has increased, and hence the allocation has increased too.
Sure. Okay. Fair enough. Nikhil, I will not come to you. I'm pretty sure you have more. You're part of our WhatsApp community, and you have time and again said that you have more than 30% exposure of your personal portfolio in alternatives.
Yeah,
But anything apart from, let's say, startup investing or debt investing via Grip, anything else?
yeah. So I would say my portfolio is 95% alternate. So maybe it's probably at the other extreme. Again, it's about, and just to be fair, I don't want the wrong message to go out. It's about understanding. You should only invest in what you understand. To be honest, this is what I understand best. I understand alternative debt better than I understand the equity markets, and I feel more comfortable about investing here. I've obviously done my fair share of investments on Grip. Uh, I do a lot of startup equity investments outside of Grip, and also commercial real estate, fractional commercial real estate, through a platform called Strata. And I have, by nature of profession, I have tried everything from P2P to crypto, to fractional insurance contracts. So I have really tried a lot of different alternative investments, but majority of the allocation is between real estate and corporate debt and SDIs.
Okay. Okay. Thank you. Uh, Street, I have an impromptu question for you because we have a lot of retail investors tuning in, watching this webinar right now. I want to understand from you when you, let's say, try and give out venture debt to any particular company. Uh, what do you look at in terms of minimizing your risk, and what can be some of the key areas where these smaller retail investors can also look and assess to figure out what kind of risk they are dealing with?
Yeah, look, no, it's a good question, Yash. To be fair, I think it's very important as we understand various businesses, their unit economics, their scale, their target addressable markets, the team behind doing this. I like to believe it will go back to founders playing a very critical role. So we can't take away at stride. We've not done a single company, and we've done a lot of PIPO companies also, where we have not got a mind space with the founders, understanding them, understanding the vision, what kind of circumstances they've come from, what kind of circumstances they've navigated, and they can possibly navigate. The quality of the team to bench strength that. So besides naturally all the financial analysis, right, which is the core to us in terms of predicting the models of past and future and doing our own case study on that because we do prepare stride case. It's very important to understand various possible scenarios which a founder or the team will go through over a period of time and how they navigate with so much of things happening domestically, globally, geopolitically. Every industry can get impacted, right? So how do you navigate that while taking care of the fundamentals? So I think that's how you should always look at any business. The businesses who made it large in India and globally came back to the scenario of how the team handled various circumstances over a period of time. Those are the businesses who become large. So it has to be in our case, we say 70% founders, right? And if we invested in Grip Invest, it's an indirect indication to the person on the call that we believed in him. So that's how it is, right? Besides what we can speak about in depth about our analysis, gating criteria, there's a lot of rigor in terms of doing credit, um, but that becomes very important.
Sure. Okay. Uh, any projections for the debt-based alternative industry from your side, Ishpreet? How big do you think this will become?
Look, I think if the education is right, people are very open to the idea. I think we have to make sure that the downside risk is understood and understanding the nuances of the asset class works because ultimately, even if there's risk, how the risk is getting mitigated and what potentially it can be, and after that, what kind of returns you generate. So all of this are coming together to answer your question specifically. I think Nikhil will have a right number of the current figure. If you can give me the current figure, I will try to project the next 5 years maybe. Nikhil, what is the current figure
I think
on the
the
debt?
assets under AIF is about $11 billion.
Okay,
That's
on
the
debt, and we're talking about debt, right?
debt
Yes.
and equity.
And is the question around debt? How much will be debt out of this?
I have asked it more from the perspective of debt-based alternatives.
Yeah,
But
so I think overall we have seen a different change in perspective. I can only say on without quoting a number that we can easily
hmm,
double from here from a perspective of our understanding of our ecosystem in the next
hmm,
3 to 5 years with more products coming.
okay.
Because for example, take venture debt an instance. When we started, it was a 110 million market, which is 1.1 billion
Hmm,
roughly. So it has grown by 10x in past 5 years. If it is grown by
hmm,
10x as a venture debt, which is a part of a larger category to alternate investment fund, there is private credit which has grown in India, right? And private credit has grown significantly in India. That's also a part of
hmm,
debt AIF. So if you take bucketize all of these and give a very conservative picture, I think it will be at least 2 3x in the next 3 odd years, and it can really further inflate depending on people understanding the downside risk. So it becomes all of our responsibility to educate. Can it go to 5x in 3 years? And with the kind of per capita income and the risk taking abilities, it can. Education, I think, will be a key role. Apurva, do you have a view there? I would love to understand your view since she's our person on fundraising.
No, so agreed, Ishpreet. I think domestic LPs, are still very shy of alternate investments. They still consider, say, a 15% allocation of their overall, corpus to be deployed in alternatives. But this is not the case internationally. Globally, even pension funds, like the safest of institutional investors, have very big allocations to alternatives as an asset class for long term. And as long as that education is there, then there's no reason why a 2-3x growth should not be there. Venture debt, of course, because the base was smaller, we've seen a very hyper growth, 10x. But even the other asset classes within alternatives are pretty much underpenetrated with a smallish base.
Also, just to add, what will propel it further is the base of the equity around it. So, for example, venture debt, right? The reason why it's become closer to 13-14% because the venture capital has shrunk in the past 2 years. So, percentage looks higher. If if the doors get open towards more private investments, by default, the credit will also pick up. Similarly for private credit, right? So, it's the overall enablement of the ecosystem which will result into high degree of credit offtake as well.
One number that caught me by surprise is, the newspapers often report the growth of the mutual fund industry, and we all talk about how this has become really large, largely on account of SIPs. But alternate capital in alternative funds today, just AIFs, I'm not even talking about platforms like Grip, is 20% of the mutual fund industry, right? So it is incredible how large AIFs have become in a very short period of time. The growth rate of AIFs has far outpaced the growth rate of mutual funds every year for the last 5 years. So, to Ishpreet and Apurva, I think the, the not only the pace of growth will continue, but we're looking at a point of time where capital under mutual funds and AIFs may be approximately the same. um, what we are hoping is that it will become more broad based. Right now, it's a very few people investing in AIFs, but can the alternative industry become really accessible to retail investors?
Okay. And Nikhil, have you set any goals for yourself at Grip in terms of any projections that how big, or you're targeting a number in terms of this many investments you want to enable by X amount of time?
Our aim is very
Sorry,
simple.
putting you right on the spot with your investors, but
Yeah, I'm just going to read out of the
yeah.
business plan that they approved, so it's okay. So our aim is to literally double every year. We are aiming to do about 1,000 crores in this financial year, and then double our business every year. And this is not just a wishful thinking. I think this is the kind of appetite we are seeing in the market. This is the kind of demand we are seeing, as well as the fact that you know regulatorily things have become more enabled for us to grow as a business. The first 10,000 rupee face value bond will probably hit the market in August. It's the first time bond will of that face value will be available for retail investors, and we expect that to be a really defining moment for investments in this space.
Okay, okay, ambitious, but much needed. Um, okay, I think we are at the end of the questions that I had prepared. Nikhil, do you want to cover anything else for this session? Otherwise, I'll move on to the questions from the audience because we have tons of them.
Yeah, I think we should, because there's so many questions from the audience.
Yeah. Uh, okay. I'll start with the first one. Then, Nikhil, the first question, which probably you'd be best suited to answer, is what is the difference between a non-convertible debenture, a bond, a SDI, and a commercial deposit, CD?
Yeah. So, Parag, all of these are, as you would have understood, all of them are fixed income instruments. NCTs and bonds are the same thing. NCT is nothing but a technical term for bonds. So, bonds, SDs, and CDs are the things you're asking about. To keep the discussion simple, CDs are short-term paper, less than 12-month paper, are CDs. So, very, very, very simply, CDs are nothing but short-term bonds. uh, Bonds are effectively where you're giving a loan to a company and you're getting an unit or a security in return, where the company has promised to pay you back interest and principal. SDIs are where the same company may have created a specific pool of assets. These could be a pool of loans, these could be a pool of leases, anything that is income generating, and assigned all the income to you as an investor. But it is ring fenced to that specific pool of assets. This is the basic difference between these different instruments. All of them, by regulation, for you to be able to invest, need to be rated and need to be listed on the stock exchange. You can go to any OBPP platform's website and discover these products. SDIs are largely available on Grip today, so you can also come to a platform see some of the YouTube videos if you'd like to learn more.
Okay. The next question I have from Ram Subramaniam is, can I open a demat account with Grip?
So Ram, today on Grip, we allow you to use your existing demat account so that you have the comfort of a single demat account for both your equity and fixed income investments. In the future, for users who choose to open a demat account, we will also be providing that facility, but today it is not available. Today you can use your existing demat account by just linking it to our through our KYC process.
Okay. Apurva, for the next question, I'll come to you. It's from Vibha, and she has asked, in your opinion, what percentage of a person's portfolio should be invested in AIF? The reason I didn't choose Nikhil because he said he has 95%, might not set a good example. So I think you're the more rational one here. So what's your opinion?
I'd say 20%. I'd say 20%
20%.
definitely. And as the understanding of the alternatives increases for any particular family or individual investor, this allocation can keep changing. But I think 20% is a good start. And within alternatives, you have so many different types of alternatives, right? There's debt
Sure.
alternatives within which you could have, say, some platform investing like Grip, or a direct fund investment like venture debt or private credit, or say a real estate AIF, or a venture capital or private equity. So there is a lot of variation even in the alternatives bucket.
Got it. Okay. Thank you. 20% is the magic number, everyone. Next question is from Aditya. Platforms to invest in SM and retail ticket size. Actually, I'll answer that quickly. There are currently no platforms which have already moved on to the SM framework. The applications are still ongoing, and SEBI will soon grant the license to one of the existing platforms that have applied. But the retail ticket size at which this asset class will come will be at a minimum of 10 lakh rupees. So let's see when it comes how these structures look like. But we'll have to wait and watch. Next question again from Raju Nair is, what investment instruments does Grip offer, and as a retail investor, are these regulated and structured? I think Nikhil, you have already answered them when you were explaining all the SDIs and CDs. I think you offer all of them as long as they're rated, listed, and they have to be regulated by one of the regulators, which is SEBI and RBI. Question for you, Apurva. Do hedge funds come under alternative investments?
Yeah, hedge funds do come under alternatives. I
I
think
would
it
say
is.
yeah.
Yeah, I think it's Cat 3, right?
Fine.
Yeah, hedge funds are Cat 3.
Cat
Three.
3
uh,
AIFs.
yeah,
Yes.
that's right.
Okay. The next question is from Sandeep Raut. How far the NCDs of small companies offering 12 to 14% for 2 to 3 years are safe, considering those are triple B plus and above? Uh, I think what they mean to ask is, are they safe? And they are offering 12 to 13 or 14% for 2 to 3 years. What's the risk in them? Nikhil, do you want to take that?
Yeah, sure. So, first of all, blanket disclosure: no investment is guaranteed, no returns are guaranteed, and there's a risk in every single investment. The credit rating is a good way and an easy way to understand the relative risk between different instruments. A triple B plus instrument is considered investment grade across the world, which means that it is meets a certain level of threshold for investors. Historical default rates in the triple B plus category have still been very low. Obviously, if you go towards A, double A, they become even lower. What is important is that as an investor, you decide whether you are open to take that level of risk, and number two, are you being adequately compensated in terms of return for that risk that you are taking. So for example, typically for a triple P plus instrument, you should look for a 13 to 14% return. Sandeep, in my view, some of the bonds that we offer on the platform, which are triple B plus, we do a lot of work behind them. These are fairly large companies, typically NBFCs, long track record. have proven themselves in being able to repay to investors, and the triple B plus may it represents the current stage of growth, but we haven't come across any kind of delay or defaults in the repayment of these companies. Once again, if you are looking to invest in these instruments and this is your first time, I would recommend for you to look at A or double A rated instruments. Just to give you a metric, A rated bonds, and this is data from CRISIL for the last decade, A rated bonds having a 2-year tenure will give between 11 to 12% returns, and historical default rates have been below 0.43%. So they have performed very, very well for the kind of return they deliver.
I think his follow-up question is how much percentage of the debt portfolio you recommend to invest in these instruments. So I think Apurva has just given us the magic 20% number in the broader alternatives category. But see, the personal finance is personal to everyone. You need to understand what works for you, what doesn't work for you, which you will over time. If not, take or seek some help from a person who can, probably plan your overall portfolio.
I would just add,
Um,
yes, that all debt should not be seen the same. All fixed income should not be seen the same.
mhm.
If someone is looking for, wants to move away from fixed deposits for a higher return, but invest in AAA rated paper, their allocation can be much higher. As you
Sure.
move to lower credit or more riskier debt, let's say A, triple B plus, or even unrated, instruments or alternative AIF funds in the debt space, then people should look at what is the right debt level for them.
Okay. Okay. Thank you, Nikhil. Question from Vibha is: can we have friends and family as co-investors in the deal? I think yes, Nikhil. Am I right? I mean, anyone can come onto the Grip platform and invest, be that friends, family, or anyone else.
Yeah, SEBI has not put any restrictions, so you can invest in a transact in an investment opportunity. So can your friends and family. In fact, we recently launched a referral program, so you can also refer our investment options and earn some of the rewards that we have.
Mhm. Okay. Uh, Question again from someone on YouTube. I want to know how Grip does due diligence for offerings of AIF in their platform.
So Hitesh, we don't offer AIFs on our platform. AIF, just to clarify, are specific alternative investment funds like the one Apurva runs. We do not offer these. What we do offer is specific instruments like corporate bonds, SDIs, and we do diligence on those. We conduct a detailed financial diligence, look at past track record, work and understand the founders, what they want to build, who the other lenders are, who has provided them equity, and in all cases, also get them rated by an external SEBI regulated agency like CRISIL, ICRA, or CARE.
Okay, in the interest of time, I want to pose some questions which might be relevant for the audience. And what we'll do is after this session, I'll try and ensure we respond back to each and every person who has uh, put in their question. One question which I find very interesting from Parag is: recently Grip listed an asset from Stride Ventures. How does Grip avoid conflict of interest if there is one?
Yeah, no, I think that's a great question, Parag. Maybe Apurva, I can start and you can add. I
Sure.
think the in my view, there's actually very high degree of alignment of interest because Stride is an equity investor in Grip. If Grip was to list an investment option that was not of good quality and that for any reason defaulted, Stride actually loses equity value and reputational risk of investing in a platform and having investors have a poor experience. So, to that extent, I think there's a very high degree of alignment just to make sure that we are communicating and clearly and being transparent about it. The disclosure on that investment provided the context of the relationship between Stride and Grip. So that's how we see it. But Apurva, if you have a different point of view, please go ahead.
No, sure, Nikhil. And I think also important to highlight that it was Stride One's listing, right, Nikhil?
That's
So
correct.
essentially, yes. So Stride One is an NBFC, of course, from the Stride group. uh, which has a very strong balance sheet. And of course, there is alignment that, as Nikhil very rightly said, that for both sides, it's important that, for protection of the equity interest of Stride Ventures, all assets that get listed on Grip's platform are of extremely high quality. And Stride One was one of those names. Stride Ventures is not listed currently on Grip's platform. Stride Ventures is the AIF arm that has invested in Grip. Stride One is a different entity, RBI regulated NBFC entity, of course, from the same group, but they do more short term invoice financing solutions.
Okay. Okay, thank you. Nikhil, one more interesting question from Jeet on YouTube is how to know the current value of my bonds, which I have, let's say, bought via Grip, so that I can probably trade them in my broker Demat account via Zerodha or via Dhan or any other broker.
Yeah. So I'd like to combine that with the question that Piyush has asked in the end on liquidity, because it's somewhere the same question. Um,
Sure.
Piyush, Yash, can I do that?
Yeah, yeah, sure, go for it.
So, obviously, bonds do not necessarily change too much in value, unlike equity instruments, because there is a fixed stream of cash flows associated with them. If you are interested in knowing the price of your bond, or you want to sell it, you can obviously contact us and we can let you know what that is likely to be, and we will try to help you exit it as well. We have recently launched in a response to Piyush's question, we've recently launched a beta feature, and we have opened it to a certain number of users as a test case, where we are enabling liquidity for investors who are purchasing bond through Grip. Over a period of time, we will open it up to all investors. We understand that investors may not want to be locked in for the full tenure of investments, and hence we want to facilitate that liquidity option for them as well, ensuring that they get a fair price at exit.
Okay, perfect. One more question, Nikhil. Are there from Harpal Singh Jadeja? Are there any investment opportunities on Grip which are not regulated by regulator?
Harpal, there are 0% unregulated investment options on Grip. Everything that you see on our platform is either regulated by SEBI, RBI, or both SEBI and RBI. So, for example, we recently launched corporate FDs, which are FDs of Bajaj Finance and Shriram Finance, also on our platform as another investment option. These are RBI regulated options, and hence every single investment option on Grip is a regulated investment option.
Okay. Okay. Any other plans to bring any different kind of assets apart from debt onto the platform, Nikhil? Maybe SM REITs or fractional real estate?
Definitely SM REITs. We believe that real
Uh-huh.
estate is, and especially commercial real estate, has a flavor of fixed income, because you get a good yield with the chance of appreciation if the real estate appreciates, and that's one asset class that we're very keen to bring on the platform. We'll be working alongside a couple of the existing fractional real estate platforms like Strata to make this possible.
I'll take the last question for the day by Subhav, which is how to invest in startups and what is the minimum amount? Apurva, maybe you can also take that if you want.
Sure. So, if you want to invest in startups and like you are investing it for the first time, there are various platforms that you can enlist yourself, like Venture Catalyst, Let's Venture, certain other incubators, where they keep running these syndication threads of various startups that are raising, and you can choose which one you want to participate in. There, you can start with a very small amount also, like as low as say 5 lakh,
Two and a
6
half,
lakh
yeah,
rupees,
2.5 to 3 lakh.
two
Yeah,
and
yeah,
a half,
sure.
3 lakh, 4 lakh. It could be anything. And so those would be for people who want to have access but are not from the ecosystem. So you can be a part of these syndicates, and whatever syndicate threads are there, you can hop onto that. Otherwise, if you know the founder, then of course, seed capital can be anything. It could be as low or as high. It depends on your appetite and the available opportunity. Yeah.
Sure. Okay. Okay, let's wrap it up. I think this was a fantastic webinar. Lots of insights for our retail investors and anyone else who was tuning in. I would like to thank our audience who took the time on a Saturday, 4 p.m., to join this webinar. And I would like to thank you both as well, Nikhil and Apurva, for your insights towards the wider audience. Uh, if you like this webinar, please don't forget to like and share this video with more people. And of course, if you're not part of the alt investor community, do join in. You can ask a lot more questions there. Nikhil is also part of the community. He'll be happy to answer more questions there as well. We'll place the link in the comments as well. But thank you so much again, Nikhil and Apurva. Thank you for your valuable time, and thank you to the audience for tuning in. Thank you.